Just moments ago, editors of the Financial Times decided what's going into tomorrow's edition. We partner with them now to bring you Lex on Bloomberg so you can get a sneak peek at what's going to be in the paper tomorrow. Neil Buckley joins us now from London. So, Neil, I know you're writing about Kraft. What are we going to read on Saturday?
Well, Deirdre, we've been doing some number crunching on the Lex team to try and work out what we think Kraft can afford to offer for Cadbury and justify that offer to its own shareholders. Remember, they're under a lot of pressure to increase their original proposed offer, which was about £7.45 per share. That comes out at about $16.8 billion in total for Cadbury's shares. We're assuming that Cadbury continues to grow its sales at about the same rate as now and that it hits its own target for operating margins by 2012. On that basis, we think that at the current price, Kraft will make a return on its investment which justifies the price that it's offering right now. But we think that that if Kraft were to increase a little bit the cost savings that it gets from the merger, and a lot of analysts think that actually they're being rather conservative with the numbers at the moment, then they could perhaps afford to raise the offer to about £8 per share or something closer to $18 billion. But it gets difficult to justify a price much above that kind of £8 a share level.
Neil, is that number going to be enough, do you think, to persuade Cadbury's board and shareholders to sell?
Well, as I said before, obviously Kraft are under a lot of pressure from Cadbury to increase their offer. But we're also seeing some pressure on the Cadbury board. Yesterday we heard of a lawsuit in the US. A US shareholder is suing Cadbury's chairman and chief executive, saying that they should be entering talks with Kraft. I think if Kraft comes back with something like an £8.50 per share, that would be about a $19 billion in total offer, then Cadbury would have to consider that very seriously indeed.
Neil, we thank you so much. Neil Buckley there from the Financial Times in London.